Those of you that experienced the great financial crisis, and more importantly, the couple of years leading up to it, like 2004, 2005, 2006, what was going on with the real estate market and the frenzy, right? Remember all the stated loans that were given out, stated income loans, and the ARMs, the adjustable rate mortgages. So I see today a couple stories I want to share with you because we're coming full circle again, and the same mistakes are being made. It will likely have the same consequence and ending for many. So out of realtor.com today, mortgage interest rates hold steady as markets remain on edge. It says the average rate on a 30-year fixed home loan edged down to 6.3% for the week, down from 6.34 the week before. Says rates though averaged 6.32% during this same period last year. Okay, here's the chart from realtor.com that shows exactly what I'm talking about. Okay, we're not going anywhere, right? You look here at these rates. You got to go all the way back to like 2022 timeframe when the rates were meaningfully lower. And so what is this? You would think that it is forcing some people on the sidelines, okay? But others are getting impatient, and they are not only biting off more than they can chew in terms of paying these inflated prices now, but they're also getting themselves back into these risky mortgages. So I'll share with you a couple stories on that before I jump in. As I always humbly ask, please subscribe to the channel if you're not subscribed so we can keep growing the channel. So out of CNBC yesterday, I saw a very short article. It says borrowers head back to riskier mortgages looking for any potential savings. The ARM, the adjustable rate mortgage share, increased to 9.5% last week from 8.4% the prior week. It says the survey showed that 5/1 ARM rates are averaging almost 1% below 30-year fixed rates. And this differential is leading more purchase and refinance applicants to consider ARMs, according to this author. Again, that was out of CNBC Real Estate yesterday. Do you guys know what a 5/1 ARM is, adjustable rate mortgage? What it means is the rate is fixed for the first 5 years, and then it adjusts at whatever the then current rate is every year thereafter until you either sell the house or you refinance out of that loan, okay? Otherwise, you're in that loan for good or for bad. So people are again saying, well, we'll throw caution to the wind because certainly rates are going to be lower, 5 years from now or 6 years from now than they are at this point. And certainly the value of our property will be higher than it is now. So these buyers are making, the ones that are impatient, okay, are making, let's say, assumptions that leave your thoughts in comments, but they really don't have any basis to make. And I'll tell you for two reasons. Number one, values are historically at nosebleed levels right now on houses, okay? And number one, so, if you do see, which I believe you probably will as a non-expert layperson, the prices start to come down. We're seeing foreclosures rising as well. So that's going to lead to greater inventory, I think, over time. Again, falling prices. Okay. And we've talked about this before on the show. Maybe the next couple interest rate cuts the Fed makes is unlikely to have a meaningful reduction in the 30-year fixed mortgage rate, okay, that's going to substantially help those out that are in a lower rate right now and want to buy a different house, or those that are stuck in an existing loan to refi out of it. But this adjustable rate mortgage thing was a fiasco in the great financial crisis, okay, because what happened was a lot of those ARMs adjusted fairly quickly, and people were simply not prepared for that. So let me throw out two things for you to think about, right? Rhetorical type questions, if you will. Number one, what if Because what everyone's telling these people now, the lenders, their realtors, their mortgage brokers, hey, you can just refi out of this loan in 5 or 6 years, or you can just sell your house and go into a different house. Well, number one, what if the value of the house drops below, what they owe on the house? Number one, okay, they don't have the option to refinance, or sell. Okay. And number two, what happens if they're stuck in that position, or whether they are or not? What happens if the rate cutting cycle, the one we're embarking on now, has come to an end? Inflation, once again, as we believe is going to happen, rears its ugly head and skyrockets, and the Fed has to reverse course and start raising rates. What happens if you start seeing 9, 10, 11, 12% mortgages? That's not out of the question, okay? And then what's going to happen to these people that have these adjustable rate mortgages where every year it will adjust up substantially, okay? So again, no one has a crystal ball, but those are risks that, again, many people, as from these stats, we're seeing an uptick in adjustable rate mortgages. They're not appreciating. So let me share a story I did pull out of Yahoo Finance. It was from about a week ago that addressed the issue. I didn't see it. It was adjustable rate mortgages are staging a comeback as buyers seek lower rates. Okay, the type of mortgage that fell out of favor in the aftermath of the great financial crisis is catching on again. Adjustable rate mortgage demand, this was about 10 days ago, has surged this year, making up 12.9% of all originations last week. So I just shared the numbers from 2 days ago where it was up 9%. So again, it's taking a greater and greater share of these loan originations. And it says that according to 10 days ago, that was a post-crisis high. Okay, and what it says is the loans allow borrowers to lock in a lower rate than, let's say, they would get on a 30-year fixed, okay, for, let's say, the first 5, 6, 7, 10 years before they start to adjust higher, okay? It says these days, though, the risks, okay, as I just discussed with you, look increasingly worth it in a punishing market of near record high home prices and elevated mortgage rates. Okay, so again, how is the risk increasingly worth it when you have those two things, high prices and high rates? Surveys suggest that many sideline home buyers want to see rates around 5.5% before they jump into the market. While 30-year mortgage rates remain far from that level, adjustable rate mortgages are close. After the crash, 2006, 7, 8, ARMs fell out of favor. By late 2008, they were less than 1% of the market, okay? Mortgage lenders tightened their requirements and ARMs gradually came back into use, but at a fraction of the pre-crisis levels, okay? The ARMs of today, they say in the article, are different. There are more safeguards put into place. But if you dig into the specifics, and I won't do that for purposes of today, it really isn't that much safer, okay? You still have the same setup. If the value of the house is not there at the time that thing readjusts, okay, and if the rates are on an uptick, not a downtick, you're going to have a higher payment and be unable to sell the property, okay? So you all know what the result's going to be there. It says, while additional safeguards protect borrowers from massive interest rate hikes, paying higher interest rates down the line remains a risk. Many people who take out ARMs now do so with plans to move or refinance before their fixed rate period ends. It says, even if you plan to stay in your home forever, the probability that you may refinance in the next 5, 7, or 10 years is probably pretty high. And that's according to Scott Bridges, chief consumer direct lending production officer at PennyMac. Okay, so it says that those borrowers can save potentially hundreds of dollars, and that's what they're doing. They're reaching into a product that is not safe to be in, has risks. Okay, they're not being patient. They're buying at the height of the market, and all they care about is what's the monthly payment now. Can I stretch to make that payment now, even if the risks down the line are higher? Still, And I'll close with this. It says there's no way to guarantee where interest rates will be years down the road. Financial advisors caution that while ARMs can make sense for people who are sure they'll move or refinance before their adjustment period starts, they've seen plans change, and it's important to consider the overall affordability of the loan. How about seeing the economy change? How about seeing interest rates change and values drop? Okay. And then the final quote, I've seen countless situations where someone will get an ARM, and then when that adjustment occurs, their finances get blown up. That's according to Alex Caswell, founder and chief executive officer of WealthScript Advisors in San Francisco. So, folks, be very, very careful with the ARMs. Okay, I'm not saying that there's no circumstance that would make sense. Every deal, stands on its own or falls on its own merits. But this is another trend that we're seeing in this, everything blow off top economy right now that we're seeing. Okay, so I'll close with that today. Another vote failed in the Senate or the House or whatever to reopen the government. So we're going on. It looks like we'll be going on to our third week of shutdown. Markets lost some today. Gold gave some back. Silver gave some back from this morning. The dollar is rallying right now. I'm trying to figure out why. You guys leave your thoughts and comments in terms of what you think is happening. So again, as I always say, if you enjoy the content, please leave me a like on the video. Subscribe to the channel if you're not subscribed. Leave your thoughts and comments. And with that being said, I'll talk to you soon. Bye.